Welcome to my YouTube video where I give everybody an update on the stock market, where I think things are headed. In the meantime, if you want to join the gang, the PT2 MV2 chart right here is a new product, beautiful product. It's color coded to buy and when to sell. And right now we're going to be following in the next few weeks. If you want to join the gang, you can follow it with us, is Tiffany. Okay, Tiffany. And Tiffany, okay, I'm sorry, let me get back up here. Tiffany, we're following Tiffany, T-I-F, there we go. Get in there we are, okay, Tiffany. Okay, and Tiffany, we're just starting. See, she just started, she's lagging behind, which is terrific. And remember, Tiffany has dropped about 40%. Look at this, so this is a wonderful stock that is on sale, okay? So the color code, the green chart right here is telling us money is starting to come in. So you can learn how to use this chart, and you can follow us on Tiffany. Try it for the next month, and you see how you make up. I'm sure you'll love it. Okay, everybody does. So easy, especially for the person is so busy. Oh, you got it. And again, we guide you through the whole thing. All right, let's get started on our site here. We have. Where's my screen here? Okay. What's going on? Everybody's talking about the market. Everybody's all excited about the market. The market's making new highs. Really? Making new highs? Let's take a look at the market over here. Okay. Making new highs. Okay. Well, here's the problem with the market making new highs. They're making new highs for the wrong reason. I remember when they gave a $2 million to a university to study, a grant to study why fish jump out of the water, then repeatedly jump back in, up and out, up and out. They spent $2 million trying to come up with some scientific reasoning why fish do that, repeatedly jump in and out of the water. And after they blew the money, the scientists finally came out with the conclusion they're just having fun. They just want to do it. That's it. No scientific. They just wanted $2 million. They just wanted to do it. It's the same thing with charting. I mean, same thing with the market. They just want to do it. Who controls the market? How high it goes now? Well, it used to be money. That's right. It used to be what they call earnings. Earnings growth. You know, it's profits. Okay, profits used to control your market. Okay, and the company's profits. Okay, what we call earnings. Earnings growth. And the market has been going up, especially in the last couple of quarters here. The market's been going up on negative growth, negative 8% in the last quarter of 2015, minus 9% in the first quarter 2016. The quarter one now is going to be about minus 5%. Okay, our economic growth here in the last quarter 2015 was about 1.4%. Terrible. Should be at 3 minimum. And then in the first quarter 2016, it was 0.5%. 0.5%. Can you believe that? And this one here, if we're lucky, it'll be 1.3%, okay, because of oil. Oil is doing so badly. But that doesn't mean anything anymore. It used to be when you have these kind, the stock market would be down here. The stock market would be down in this area right here. Those days are gone forever. What controls the stock market is engineering. Listen to this. This is Richard Fisher talking about how the Fed engineers the stock market.
We deliberately engineered as a central bank, 0 interest rates at the bottom of the anchor of the curve, and then flatten that curve by buying massive amounts of treasuries.
Now, why is he buying massive amounts of treasuries? They buy massive amounts of treasuries like they're doing now. That buying massive amounts of treasury is called QE. That's right, QE. Massive amounts of treasury, they buy them so that because who buys our treasuries? Well, you have a lot of people buy bonds. We know that. A lot of people scared of the stock market, go to the bond market. They feel it's safe. And every time bonds are bought, okay, the yield or the interest drops, okay, and it keeps dropping. More people buy bonds. Bonds go up, right? And the way it works with the bonds, it's a little confusing. You buy a bond, right? As the bond's going up, okay, price is going up, your yields are going down. Now, people who buy our treasury, countries who buy our debt from us, okay, they buy because they want the yields. They don't care about this. They want the yields. But when they, so what we do, Yellen does, she takes the printing machine right here, okay, the rally stock market, she takes the printing machine, okay, and with the printing machine, she makes all kinds of money, and then she goes out and buys the 10-year treasury. So she goes out and buys these 10-year treasuries, okay? And when she buys the 10-year treasury, she buys them and buys them. They're buying, they between 2009 and 2012, they were buying 85 billion a month to keep driving the price lower, okay? To keep driving the yields lower. Why would they do that? Well, because you lower the yield, if I'm China or I'm some other country, okay, let's say the Saudis, okay, I want yields. I want to at least get a 3% return. So if I'm going to buy the debt that let's say Congress spends a trillion, let's say Congress spends $1 trillion more than they take in, okay? Well, China will come in and buy that, okay? But they only buy it if they're getting a good yield. Well, what they do, the Treasury Department, the Fed will buy these so that keeps driving them down so they won't buy. So now it's down to 1.4. So these countries no longer are interested because they just don't like the yield. So what do? Instead, they come over and they buy the stock market. Okay, and that's how they get the stock market to go up when it's stuck. They get the stock market to go up by driving these yields down, and it pushes them into the stock market. So we have an inflated market that's too expensive. So the market has gone up, and we have a PE multiple, okay, or what the market is worth is out of whack. They're saying it's a PE of 19 when it should be really 14, okay, and because they can't justify the 19 because the earnings growth is so bad. Now, when you buy a stock, what makes a stock go up from $5, okay, to $10 is earnings, okay, is the earnings, how much money they're making, and they want the earnings growth to go up, and that's what makes the stock go up, see? Well, earnings are not going up. Earnings are going down. Earnings growth is going down. So what they're doing is buying more of these bonds to keep pushing the stock market up because these companies are going to $5 to $10 instead of because the earnings are going up, okay? They're able to move the stock price up by having, again, getting the Saudis, Chinese to buy the stock market. The other thing that makes the stock go up is when companies buy their own stock, called stock buybacks. That pushes up the stock price when there is no profits, okay? No earnings, rather. So it's all fake. So this whole rally from here to here, 2012 to 2016, is all fake, overbought. So what they're going to do is try to keep this going between here and November to get Hillary elected. All right. And the way they're going to do it is keep on buying more bonds. So all we're going to do is make sure we keep finding good opportunities like we have with Tiffany, okay, and some other stocks so we can profit while they're engineering the market to go up so Hillary can win the election. But overall, the stock market, what it's doing, the stock market overall is being controlled by this idiot right here, okay? She's continuing to print money, okay, and she's spreading money all around at low interest, near zero, and she's giving it to the banks, she's giving it to hedge funds, and that's how they're keeping the market artificially up, but it won't last. And when it crashes, let me tell you, it's going to be a much deeper and bigger crash than these were, I'll tell you that. And right now, everybody's worried about the market up here being so high, and they should be, okay? Not if you're a gang member, because we benefit, because when the market drops, we're going to know well in advance. Remember, stock markets don't drop overnight. That you don't wake up in the morning, the market's down, or go to lunch, come back, the market's down 1,000 points. That's a fallacy. It's not how it works, okay? It takes a long time. You get a lot of messages from the market, and our messages come in from a color-coded chart. We know when to sell right here. See, we know exactly when to sell when it turns red, okay? So the economy right now, as I say, the stock market is artificial. We have PE ratios that are giving us nosebleeds. We don't have good earnings. Earnings are still terrible, and they're going to have to do QE4. Do QE4. When they do QE4, they're going to tell you the following. They're going to tell you by doing QE4, we're going to come in and companies are going to be all excited because we're going to give them money at zero interest to borrow money, and they're going to go out and buy all kinds of equipment, and they're going to buy machinery, and they're going to buy technology, and that in turn is going to cause productivity, create more jobs, wages will go up. This will be a wonderful thing. That's a whole lie. That's not what happens. They don't spend money on technology. They don't spend money on new machinery or anything else. They take that money and they go to the window of the Federal Reserve and borrow more money, and they take their profits and the money they borrow, put it together, and they don't plow it back in for equipment or anything else. They plow it back in the CEO to buy his own shares back. And when he buys his own shares back, that's what makes, from 2012, that's how we got up to here, buying their own shares back. Now, they buy the shares to force the market up, because the more shares you buy a company, the less shares you have outstanding. The less shares you have outstanding artificially pushes up earnings that you didn't have, and artificially pushes the stock up. Now, companies are built, when they do that, they're borrowing and borrowing and borrowing, and what they're doing is they're building a lot of debt, because companies, when they borrow to push their stock up, they got to pay it back. Okay, they got to pay it back. So they're building debt, but they don't care. The CEOs don't care, because his compensation is tied to stock options. And the more stocks he buy back, the higher the stock goes, without having profits, without having sales. And none of the money dribbles down to Main Street or the employees. They just lie to us that it is, okay? So only the 5 percentile make money, okay, because they control 85% of the stock. And what about the people in 401ks? They don't make any money. Why? Because their average return, even the best year, is 1.8%. That's before taxes, okay? They never make any money. And you got all the expenses. They don't make any money, the 401k. They get screwed. Just like I said the other day, remember, you don't get a match. No employee gives you free money. What they do is they take it from your pay. What's that mean? When you go in and you apply for a job, and let's say you have two companies. You have this company here, and you have this company over here, and it's the same job. Over here, you get paid $50,000 and you get a 401k, okay? Over here, you get $58,000 with no 401k. See what they do? They already take that job slot, drop it down from 58 to 50 to offer you a 401k, so that you're only getting your own money. They never give you free money. It's the biggest scam there is, okay? So if you go and work for a company that doesn't offer 401k, you get more money. That's how it works, okay? All right, I'll see you on the charts. Join my gang, Phil's gang. I hope you now understand the market better than you did before I gave you this video. See you on the charts.